What we wanted to do is to find a way to take advantage of this transformational tailwind, and we began to look for ways to profit from the changing consumer while remaining non-correlated to major asset classes. We sought out 4 primary characteristics. First, we wanted assets that had very high quality and resilient revenues, something that was durable through a recession, something that was predictable and persistent. We also wanted to find something that would give us a direct way to participate in this changing consumer. We also wanted to find something that would benefit, to invest in companies or industries that would directly benefit from rising inflation, that would have very low correlation to stocks and broad economic trends. And finally, we wanted to invest in assets that had scarcity and very defensible moats. So while it's not going to be a surprise to you that during a recession, the S&P 500's revenue drops pretty dramatically, what might be a surprise to you is that the big 4 sports leagues, their revenue has actually stayed strong and been persistent and positive through those slowdowns in the economy. We also know that it's less volatile. And what this chart shows is how we've had good, strong revenue growth. We've also experienced it with a lot less volatility than most other industries or most other sectors. Now, what might surprise you the most is that how well these assets have performed over time, especially during downturns. Not only did they not go down like the S&P 500 would go, like you would expect in the middle of a recession, stock prices usually drop. The big 4 sports leagues, they actually saw the assets on average go up in the recession, and over the last 20 years have delivered a 9.4x multiple on invested capital compared to the S&P, which has done well, but is only up 3 times. Well, don't know about you, but we prefer 9 times our money rather than 3 times our money a lot more.